on the income statement. Yeah. So, and this can, it actually, these transaction gains or losses, they can have a huge impact on earnings. Yeah. Earnings are what analysts are very focused on, and whatever the currencies and the exchange rates do can matter and can influence the earnings of a company. If you have a foreign subsidiary, and we talk about exchange rates there, because the consolidation, for consolidation, you have to deal with currency, and it's something different. Then it's not called a transaction gain, because a translation adjustment, yeah, you have to at the end of every year, you have to translate the financial statements of the foreign subsidiary into the parent's currency. Yeah, and if the subsidiary, subsidiary is based in a foreign country, so you have to translate that. You have to take into account that you have a different currency, and this change in currency from one year to the other is called foreign currency translation adjustment. Yeah, it's not called transaction gain or loss, like with goods and services when you sell them and buy them, but it's instead it's called foreign currency translation adjustment. Yeah. So this is the adjustment that results from a change in currency one year to another. Yeah. And the difference between this foreign currency translation adjustment and the transaction gain is that the translation adjustment appears as part of all other comprehensive income. Yeah. It does not influence net income. It does not influence earnings per share, but instead it influences only other comprehensive income. So this is the difference between a foreign currency translation adjustments, which has to do with subsidiary translations. When you have a foreign subsidiary, and transaction gains. Transaction gains are something different. So transaction gains are when you sell or buy goods in a denominated in a foreign currency, and the currency changes from the point in time when you sell the good or product to the point in time when you receive the money. Yeah, and of course it affects the balance sheet. It also affects shareholders' equity when those currencies changes, but it does not affect the income statement. It affects other comprehensive income, but not net income. Does that make sense? Or are there any questions here? No questions? Then we can go on. I sent you the new slides. Did you get the slides? Okay, fine. No? Have a look again at your email account. Okay, all right. And then we can go on with the new slides. And the new slides are about liabilities. When you think about liabilities, when you hear the word liabilities, what do you think about? What is a liability? Yeah, you owe something. This is correct, right, John? Yeah, but it would be even better if you could use your microphone. But the answer is correct. So you owe something to someone, and you think about liabilities. You often think about debt. You go to bank and you get bank loan, something like that. But liabilities can also be something different. Yeah, for example, accounts payable. You buy something, but often you do not pay immediately, and then you have an account payable. Yeah. This is the definition of a liability. It's a present obligation which will be settled through an outflow of resources embodying economic benefits. Yeah, this is the definition of the standard. So it's debt, but it's not only debt. Yeah, so debt, but it can also be, for example, accounts payable. It can be unearned revenues. Yeah, I think we already talked about unearned revenues. But yeah, generally liabilities evoke negative emotions because you owe something to someone. Yeah, so it means you have an outflow of resources in the future, which is something bad, of course. But if you have liabilities, it is important to show them. And there's no business without liabilities. Yeah, there are businesses without long-term debt. Yeah, businesses that do not have debt from a bank, but at least you have some accounts payable or taxes payable. Yeah, and the creditors and also the investors, they want to know what your liabilities are as a business. Yeah, how creditworthy you are. So you have to show it in your balance sheet. When we're talking about liabilities, we're talking about short-term liabilities and long-term liabilities. So you have to differentiate between short-term or long-term. For short-term liabilities means they are shorter than 1 year, or they are paid within the operating cycle. Again, what is the operating cycle? Operating cycle means your the goods and services that you buy, produce, and then sell, and then turn into cash. Yeah. For example, for BMW, the operating cycle is BMW, the buying and the producing and selling of cars. So in the case of BMW has cash on hands, on the hand, then it buys some raw materials, it produces a car, it has a finished products, it sells the finished products, it has an account receivable, and then the customer pays and it gets the money back. Yeah. So this is the operating cycle. And those liabilities are categorized as short-term liabilities. And the short-term liabilities, they are expressed in nominal amounts. What does nominal amounts mean? Do you have an idea? Excuse me, can you repeat it? I didn't get this. Okay, it's the nominal amount is the amount stated on the instrument. Yeah, it's the amount stated on the instrument.
Is it the principal?
Yeah, exactly. Very good, Raychan. Very good. It's the principal, exactly. Yeah, very good. When we're talking about long-term liabilities, then it's not expressed in the nominal amount, in the principal, but rather it is expressed in present value. Do you also have an idea what present values are?
Something or the money, the value of the things or cash in the present.
Yeah, very good, Raychan. It is you take into account the time value of money, and you discount all future cash flows. So this is not the principal, but really the discounted value of the cash flow. Very good. Yeah. So this is the difference between short-term liabilities and long-term liabilities. Long-term liabilities are expressed in present values, and short-term liabilities are expressed in nominal amount. So now we come to certain types of liabilities. One we already talked about shortly is accounts payable. Accounts payable is when you buy a product and do not pay immediately. Yeah, so they are typically short-term, and actually buying, for example, buying merchandise is the most common transaction for a merchant. Yeah, and that's why they have a lot of accounts payable. Usually the credit terms that you get when you have an account payable are 30 to 90 days. Yeah, and it's mostly used for financing inventory. Yeah, so also it's very important for retail firms. Yeah, think about Amazon or Walmart or Aldi. Yeah, these kind of firms. Yeah, or also Baidu. Yeah, Baidu is also a retailer. Yeah. Yeah. So they have also a lot of accounts payable, probably. Yeah. Then we have accrued expenses. accrued expenses are expenses incurred but not yet paid. These are also called accrued liabilities, yeah, and they are usually short-term liabilities, yeah. So there are different subcategories. For example, accrued salary or accrued wages, yeah, and especially for service firms. This employee compensation is the most important expense. Yeah? Think about consulting firms, auditing firms, investment banks, all that kind of firms. They have to pay a lot of salary. Yeah? This is the biggest expense position for them. And therefore, if they do not pay immediately, but later, then this is also salary payable. Yeah, it's also an important expense. Yeah. Then we have taxes payable. Yeah, firms have to pay taxes, but taxes are sometimes not paid immediately. Yeah, say they first you get the check from tax authority, from the tax agency, and then later you pay. Yeah, in between you have a tax payable. Yeah, there is consumption tax in nearly every country. Yeah, and the most important consumption tax is probably the value-added tax. Value-added tax. And then you have income tax. Yeah, you have income tax for corporations, income tax for individuals. Income tax for corporations is called the corporate tax. Yeah, and all these taxes, sometimes they are not paid immediately, and until they are paid, they sit on the balance sheet as a liability, which is called taxes payable. Yeah. Does that make sense? Or do you have questions so far?
Clear.
Clear. Okay. No questions. Then we go on. Unearned revenues. Unearned revenues are actually are revenues collected in advance. Yeah, unearned revenues doesn't sound like a liability. It sounds like a revenue, but it is a liability. Yeah. Think about you get a gift card, or actually let's put it the other way around. A company provides gift cards to the customers. Yeah, provides gift cards, and the customer buys the gift cards. What does the company get? The company gets cash. Yeah, but until the customer goes to the store and buys something with the gift card, the company has a liability. It's an obligation. Yeah, the company has the liability to provide the goods to the customer, and this is called unearned revenues. Yeah. So think about, for example, Starbucks. Yeah, you can buy at Starbucks as a customer. You can buy a Starbucks card. Yeah, the Starbucks card. If you buy the Starbucks card, the company Starbucks gets money. Until you have bought your coffee. Until you have bought your coffee, the company has an obligation against you. Why? Because it has promised you that when you go to the store and show your card, that you get your coffee. So this is an obligation, and the obligation is called unearned revenue. Yeah. Does that make sense to you?
Yes.
Yes, okay. Then we have sorry. These are the journal entries for unearned revenues. Let's say the first journal entry is when the customer goes to Starbucks and buys the Starbucks card. Yeah. What does Starbucks get? It gets cash. Yeah. You debit cash. Cash is which elements of the accounting equation are touched here? What is cash? Is cash an asset? Is cash an asset, or is it cash a liability, or is it equity? Asset, exactly. So cash goes up. Unearned revenue. What is unearned revenue again? We just talked about it. No, it's a liability. It's an obligation. It's a liability. So if you credit a liability, it goes up. Yeah. So the company Starbucks has the obligation to give you the coffee whenever you go to Starbucks with the Starbucks card. Okay, good. Then later on, you are the customer, and you walk into the store with your with your Starbucks card. What happens now? You debit unearned revenue. Tell me which elements are touched here. You debit unearned revenue and you credit sales revenue. Yeah, very good. Yeah, so liabilities goes down, unearned revenue. If you debit unearned revenue, liability goes down, and you credit sales revenue, which essentially means that you have a higher sales. Higher sales leads to higher net income, and net income goes into retained earnings, and that increases your equity. Very good. Yeah, very good. Good job. The next topic is pension liabilities. And with pension liabilities, there is a distinction between defined contribution plans and defined benefits plans. The defined contribution plans essentially means that the firm's obligation ends once the payment is made. Once the payment has been made. So when the firm pays, then it has no obligation anymore. Yeah. So then the responsibility is at the employee. Yeah. So this is defined contribution plan. Defined benefit plan is different. Yeah. In earlier times, defined benefit plans were much more prevalent, but now firms are shifting more and more to defined contribution plans. What are defined benefit plans? Here, the firm is responsible to pay the pension. Yeah, here is the firm is responsible to pay the pension. Firm is responsible to pay the pension, it promises, the firm promises a fixed pension in the future. Yeah. So, and that's why the responsibility lies at the firm. Here, the responsibility lies at the employee. Yeah, here. Employee is responsible. Once the payment is made, the employee is responsible. The defined contribution plan here on the left-hand side is very easy from an accounting standpoint. Actually, you do not have to have a liability at all as a firm. Why? Because it's just an expense whenever you pay something for your employees. Yeah. But here, the defined benefit plan is more complex. Yeah, it's more complex. And it's more complex. And at the end of the period, a firm always has to compare the fair market value of the assets in the retirement plan with the plan's accumulated benefit obligation. Yeah. What is the fair market value? What is, if you think about fair market value of the assets in a retirement plan, what is this? What are we thinking about here? This is the market prices of bonds or stocks. Yeah, whatever the pension is invested in. Of stocks or bonds. So if you have to, the firm has to compare these market prices of the assets with the accumulated benefit obligation. Yeah, that's the obligation. This is what the firm has to pay for an employee at a certain time. Yeah, and of course the firm wants the fair the market prices to be higher than the obligation, because that means actually that the firm can meet the obligation. Yeah, that it has enough money to pay when it sells the stocks and bonds. So, and this is when the plan is called overfunded, when the fair market value of the assets of the stocks and bonds, fair market value of the assets, the market prices is higher than the obligation. This is good. Yeah, then the plan is overfunded. This is a good thing for the firm. And the firm is the plan is overfunded. It is underfunded, however, if the market prices are lower than the obligation. And then if this is the case, yeah, if it is underfunded, then you have to put the excess liability, the difference between the two. Excess liability means the difference has to be put on the balance sheet. Yeah, so this has to be put on the balance sheet as a liability. Yeah, but this is only for defined benefit plans here. This is only for defined benefit plans. Defined contribution plans, it's just an expense every year, whatever, and then there is no obligation for the company. With defined contribution plans, the employee itself can invest the money and choose whatever asset class he or she wants. But here, with defined benefit plans, it's the company which is responsible. Yeah, and if the defined benefit plan is underfunded, which means that the prices, the market prices of the assets is lower than the benefit of the obligation, there is an excess liability which has to be put on the balance sheet. Yeah. On the other hand, if the plan is overfunded, you can argue, oh, then there is an asset. There's an asset, an excess asset. But firms are not allowed to put that asset on the balance sheet. They are only allowed to show it in the notes. Yeah, overfunded plans are only allowed to be shown in the on the notes. Yeah, so call that excess asset only in the notes. Yeah. So the standard setter says, IFRS says, we have to be conservative. That's why excess asset is not allowed to be put on the balance sheet, but rather only in the note. Yeah. Do you have any questions related to these pension obligations, pension liabilities? It's clear? Okay. Thank you. The next liability we're going to talk about is a provision. And the provision is a liability with uncertain timing and amount. So the timing and the amount is not sure. Yeah, it's not sure, it's uncertain. You do not know how much you have to pay and whether you have to pay at all. Yeah, it has to be probable. It has to be, a provision has to be probable, and probable means the likelihood is more than 50%. More than 50%. More than 50% likely. Yeah, that is the definition of probable. Yeah, so this a provision meets the definition of a liability, but you have to be aware that there's a lot of probable and uncertainty involved. Yeah, but it is a liability that decreases equity and earnings, and it is on the balance sheet. Yeah. So can you name? Do you know of any examples for provisions? Do you have an idea? One example would be anticipated settlement costs of legal disputes. Yeah. So if you have a legal dispute, think about tobacco companies. Yeah. Tobacco companies like, I don't know, Philip Morris or Marlboro. Yeah. They have legal disputes with the customers. Yeah. The customer says, okay, we're getting sick, and we blame the firm, and then from time to time they are in front of the courtroom or in the courtroom, and those legal disputes from time to time they lose. Yeah. And this is a provision. Yeah. The provision has to be set up for the possibility that you'll use the legal dispute. Yeah. Another common provision is warranty agreements. Yeah. Think about vehicles. Think about cars. Think about BMW. Yeah. So BMW or Volkswagen has the obligation to perform repairs. Yeah, it has the obligation to perform repairs, and therefore it has to create a provision. Yeah, and the amount of the provision is the probability weighted expected value. So the probability weighted expected value. Yeah. So basically, what firms have to do, they have to calculate. Let's say we have a legal dispute, and we have a potential a loss of 200. Yeah, 200. Let's say this is 200 euro. Yeah, and the probability of this is 60%. 60%. But it might also be that we win, the company wins, and therefore our outflow is 0. Yeah, and this probability is 40%. Yeah. So what is the probability? What is the probability weighted expected value for this legal dispute? Think about this as a tobacco company. Yeah, Liang, it is minus 200 times 60, and this is minus 120. Very good, Liang. Very good. Good job. Yeah, this is the probability weighted expected value. No, I forgot the value. Yeah, minus 120, minus 120, minus 120 euro. Very good. These are the for example, yeah, you debit expense and you credit the provision, which elements of the accounting equation are touched here. When you debit a warranty expense and you credit a provision. What is an expense and which element is touched? Exactly, yeah. Equity goes down. Very good. Yeah, so equity goes down and liability, what happens to liability? Goes up or down? Exactly. Very good, Liang. Equity goes down because we have an expense. Expenses reduce our net income. Lower net income means lower net earnings. Retained earnings means lower equity. Liabilities go up. Why? Because a provision is a liability. When you credit a liability, it goes up. Very good. Okay. And then the journal entry, when the firm actually pays. Yeah, let's say the firm has to pay now for its legal dispute. Which elements are touched here? Which are? Yeah, the liability goes down. You debit a liability, it goes down, and you credit an asset, it goes down. Yeah, and it makes sense because when you pay, cash has to go down. Yeah. Does that make sense to everyone? Yes. Okay. Good job so far. Then we have another liability, but this is a liability which is not shown on the balance sheet. It's called contingent liabilities. Yeah, and the difference between a provision and a contingent liability is the probability, the likelihood. Yeah, it is also a possible obligation. Yeah, the contingent liability, similar to the provision, is also a possible obligation. But here it says probably will not. Present obligation may, but probably will not require an outflow of resources. And probably will not means less than 50%. Less than 50% likelihood. Yeah, this is the difference to the provision. The provision says more than 50%. Also a sufficiently reliably estimate of the amount of a present obligation cannot be made. Yeah, and therefore it's not really reliable. It's unlikely, and you cannot make a reliable estimate, and that's why it only appears in the notes. Yeah, only in the notes, not on the balance sheet. Not on the balance sheet. Yeah, for them, contingent liabilities only in the notes. The notes are there to explain. They're not the balance sheet. They are not the financial statement. So a contingent liability is not a real liability, at least not in an accounting sense that it is on the balance sheet. Yeah, it doesn't. If you set it up, it does not affect income, and it does not increase the liabilities on the balance sheet. Okay. All right. Any questions here? No questions? Then I suggest we have a break and see you in 15 minutes. See you in 15 minutes.